All right. Well, hey, let's get going on this presentation. I kind of just want to give you an overview of what captives are, who we are, but then also look at different case studies. How do captives really impact your particular clients? And so if you've got questions along the way, definitely let me know so we can answer those. So we will get going. I'm going to share my screen with you. There we go. Make sure I get my point. There we go. Got my pointer up. We're ready to go. So first of all, who we are. I am a CPA. However, I do not do typical CPA work anymore. I don't do tax returns, bookkeeping audits, nothing like that. We just create and manage captive insurance companies for business owners. It keeps us busy. So what is a captive insurance company? It's a private insurance company that is owned by the business owner. It's a risk management tool. And overall, I like to describe it as just a good business strategy. We don't own. Most people think, oh, insurance, I don't want any more insurance. I don't want another expense. I hate seeing money go out the door. But this is going over to your own insurance company. So it's different. It's different. And you're able to get all kind of strategies to manage your risk. Who does a captive work for? It's going to work really for any business that has gross revenue, total receipts, total sales of around $1 million. This has really changed in the last year or two. Insurance rates have gone through the roof. You probably know your clients have experienced that. And so because of that, business owners that even if they just gross total sales of $1 million or more or less, we've done some that are 700,000, 800,000 in gross revenue, and it works for them. What kind of business can benefit from it? It's really any type of business. Doctors love these, and this works really well for physicians. Manufacturers, construction companies love these as well. Healthcare, oil and gas, transportation. There's a lot going on in the transportation world. So they're really interested. Their rates are so high. And by integrating a captive, you can lower those costs. You got wholesale, auto, retail, professional services, CPA firms, legal, attorneys, financial advisors, and opportunity zones. So it's any business. Why any business? Because every business has risk. And so you can get those risks covered by your own captive. So I want to kind of go briefly over the structure of a captive. Remember I said we don't own the insurance company, you do. So the owners of the business, they're going to own the captive. It's owned in the same way as your current business, right? It mirrors the ownership of your business. And the way it's going to work is, an independent actuary is going to look at your business and say, you have X amount of risk. To cover this risk would be 15 different policies. The owners say, okay, yeah, we want to do that. And so they're going to write a check over to their own captive insurance company. Your captive is then going to issue policies to cover the business. All those policies are reinsured. This captive is a true licensed insurance company. The great thing about it, the premiums are deductible for your business. They come over to your captive and they're tax-free to your captive. I'm going to get into more detail about that a little later. And then your captive, when you do have a loss in your business, your captive will pay for that loss through the reinsurance. So powerful strategy. It really does three different things. It's going to protect your business. That is the primary reason why you do a captive. A lot of people like the second reason, and that is to decrease taxes. It definitely does that. It's a very efficient vehicle for doing that. As a CPA, I like that aspect of it. And then the third thing that it does is build wealth. And so we're going to touch on each one of those. First of all, it protects your business. People spend a lifetime for their business, right? They're building it up 20, 30 years. They don't want anything to happen. Why? That's their cash cow, right? That is making them money. And so they can protect what they built by having a captive insurance company. This integrates with your traditional commercial insurance. You're not dropping all your insurance. You're not going completely self-insured. You're going to keep your regular insurance, but a lot of times it can become cheaper because you're integrating aspects of the captive into that, and that will help lower your cost. Now, when we talk about protecting your business, you're going to get policies that your traditional commercial insurance carrier is not going to cover. They're not even going to offer it, right? Because they have to be able to predict. They're interested in two things: prediction and profitability. If they can't predict the loss, then there's no way they're going to insure it, right? And because they don't know what kind of profit they would have on it. So it's very important. When you look at, well, what would my traditional commercial insurance cover, and then what would my captive cover? Let's take a look at that. If you've ever gotten your commercial insurance policy, isn't it interesting where it's like one page of what's covered and then like 300 pages of what's not covered, right? Those are the gaps, the exclusions, the deductibles, and things like that. So that right now, you're kind of self-insuring for that. You're just hoping something doesn't happen. Well, you can get all those things covered inside your captive, right? Your traditional commercial insurance is still going to be there, but it doesn't cover all of your risk. What's kind of interesting on commercial insurance, traditional, is when you go to file a claim, they think of every excuse in the book not to pay you, right? I mean, they're just trying to find a way not to pay you. Whereas captive claims are written very broadly. Commercial claims are written very, typical commercial insurance written very narrowly. They don't want to pay you much, right? You got deductibles, you got all this stuff. Whereas a captive, it's written very broadly. It's designed to pay you. Why? It's your own insurance company. You want to be able to get money out of it, right? And so that's what captives are as far as captive policies, and they're claim friendly. Now let's jump into what a captive covers, right? Remember, it's going to cover things your traditional insurance does not cover. And one of those, this is a extreme partial list. There's literally over 1,000 different policies that a business could get. So there's a tremendous amount of that. So let's take a look at some of these here and see. All right, first of all, business interruption. How many times have you seen road construction and you're like, oh man, that business must be suffering because there's no way people can get to them, or it's very difficult. If they had a captive, they could file a claim and get paid the loss of revenue that they typically would have had on a Tuesday, but now because of construction, now they don't get that. They can file a claim and get paid. So their business interruption, there's a lot of things that interrupt business, right? There's a lot. Something else that it covers, this collections receivables. This is becoming pretty popular. You've heard of accounts receivable insurance, right? Where they are going to cover if you've got bad debt. You pay X amount, right, in premium, and then maybe you're able to make a claim, maybe you don't. It's a gamble, right? You just don't know. You can do the same exact thing inside of your captive. However, there's no deductible. So, this really came into the case of a particular client of ours. They're a protective case company, and a lot of their cases are made overseas. Well, COVID hits, impacts everything, right? They can't get shipments of their cases over to the US. They had a loss of revenue. They filed a claim. They got paid that loss of revenue. The next thing that happened a little bit later was a lot of their customers went out of business because of COVID. And so now they've got all this bad debt. Who's going to cover that bad debt? Do they just have to eat it? Nope. They've got a captive. And so they were able to file a claim. The reinsurance paid a good majority of that. So, when you put money into the captive, it's not, if you don't use it, you don't lose it. Whereas traditional commercial insurance, once it's gone, you send the money out, you never get it back. I mean, when was the last time State Farm called you up and said, hey, Joe, you never filed any claims this year. we're just glad you're a customer. We're sending all your money back. It never happens, right? It never happens. But with the captive, that's exactly what happens. We touched on a little bit already the commercial limits and exclusions. You know, a lot of your insurance policies will have limits of maybe $1 million, right? What happens if you go over those $1 million? You're going to just pay yourself. If you had a captive, it would cover that. Deductibles is something else that can be insured. We'll talk a little bit more about that. And so any gaps, any things that fall into gaps can be covered. And then, of course, coronavirus, the pandemic, things that are happening right now can be covered inside a captive. Could you get some coverage in your traditional? Yeah, but it's going to be expensive. And you may or may not use it. It's going to be very narrowly written. Why not do it within the captive? I'm going to give you an example of that. We had a Lasik eye surgeon. And if you remember back over a year ago, remember they were forcing a lot of, what they call it, non-essential medical personnel to shut down, right? Well, Lasik is not essential, right? People want to see better, but it's not essential. Not like having a heart attack and you need open heart surgery. So the government forced the shutdown of the Lasik eye surgeon. They lost a lot of money, right? They lost a lot of money, but they had a captive. They set up a captive through us. They were able to file a claim and receive $1 million in lost revenue all the time while they're sitting at the house. It makes a big difference. It helped a tremendous amount to keep the value of that company up, to keep the income of that business owner intact. So powerful strategy, better to have it than not have it, right? And then every week you hear of another company getting hit with cyber risk or data loss. You have ransomware, right? School districts, cities, all kind of businesses, large and small, are getting hit with this. And the cost is outrageous. In 2019, 11 billion. In 2020, 20 billion. They're fine. This is just a new business for them, right? But if you get hit with it, your business stops. What are you going to do if they demand $500,000? Where are you going to get that? Have a captive, file a claim, get the $500,000 or the $1 million, whatever they are asking for, and your business continues to roll down the road. So powerful, very, very powerful. The next thing is the deductible reimbursement. A lot of times a captive, again, remember, it's trying to cover the things, it's going to surround your current insurance. It's going to cover things that your traditional does not. All of them have deductibles, right? Every single one of them have deductibles. And so you're able to increase your deductibles on your traditional and then insure the deductible inside the captive so that if you need that money, you can just grab it inside the captive. It's very, very powerful. And I'll give you an example about that in just a minute here. So what's the other thing? Loss of key client contractors. Okay, people love this one. This is a great policy. A lot of times, like marketing agencies, other companies, they may have 3 clients that make up 80% of their revenue. And if they were to lose one of those, that would hurt them in a big, big way. Now, when I mean lose, I mean maybe the client went out of business. Maybe they left and went to a competitor. Whatever the situation is, they left them. They can file a claim and get paid what that customer would have paid them for the year. You think your client would be happy? Yeah, it's a huge deal. What does that do? It gives them time. It gives them money and time to go find another customer to replace the one that they lost. Another one that's huge is the loss of a key employee. How many businesses have where the business owners are checked out, right? I mean, they're kind of pretty much semi-retired. They're on the beach somewhere. Why? They have key employees running everything. But if they lost that key employee, oh man, they would be in a world of hurt, right? That key employee may be worth 2 employees I mean, to replace them in their knowledge, it may take 2 or 3. If they lose them, they can then file a claim, get paid their value, that key employee's value, and keep rolling down the road. Same things with the salesperson. Let's say you have a salesperson that brings in $500,000 a year. They quit. What are you going to do? File a claim if you have a captive and get paid $500,000. That keeps your company healthy. So very, very powerful on that. Hey, does anybody have any questions on any of those so far? Outstanding. Outstanding. Okay. Well, if you do, just pop up, say something. Loss of a key supplier is another great policy to have. Maybe you've been doing business with a key supplier for a long time, and they're half the price of the competitor, and they go out of business for whatever reason. Now your price is going to increase. And what's that going to do to your profit margin? Make it go down, right? And so by having a captive, you can file a claim and get paid the difference between what your costs were and what they are now. Do you see how that's a great business strategy? Absolutely. It's a great one. Another one is product warranty recall. You know, you may have, hey, we have a warranty on our product. We have a guarantee. Well, how are you covering that? You know, how are you covering that deal? You can get those costs covered through the captive. Here's one we're dealing with this week. Talking to a M&A, a merger and acquisition company. And, you know, for the business seller, when they are saying, hey, our company does X amount of business, here's what the books look like. Well, this M&A, this private equity company is going to buy them. But nearly every single time, something's not right. Right? Maybe they overstated their sales. Maybe their books aren't right. You know, they're going to do an audit. There's going to be adjustments. There's going to be issues. If there's a captive, if the seller has a captive, they're going to be able to get that covered, whatever that difference is, inside the captive, right? So it's tremendous. Or let's say they get bought, and part of the agreement is you got to stay on. We're going to pay you $1 million a year for 5 years. Okay, great. Sounds good. That's going to be revenue. What are their expenses going to be? There are none, right? Because it's a consulting gig now. They need to have a captive because that's going to allow them to deduct different types of expenses, different types of risk associated with that. And so now the seller is going to be able to, you know, save a tremendous amount on their taxes and get a lot of things covered that they don't have coverage for. Another one is regulatory changes. And I'll give you an example of this. You know, let's see, let's just pop to one of those real quick. Medical office. They provide care to long-term care facilities. And they called us up and said, hey, look, I don't think I'm going to be able to put much in the captive this year. Why? What's going on? Well, insurance doesn't pay us 20 days a month anymore. They said they're only going to pay us 4 days a month. Well, that's a tremendous loss of revenue. We said, hold up. You have got coverage for this particular situation. It's called a regulatory change. You're going to be losing money, but you don't have to because you got to change. They filed a claim and they received $1.5 million in lost revenue. Look, captives are there to provide insurance coverage for your business. And it really pays off. If you don't use it, you don't lose it, but I'd rather have it than not. Are you with me? Absolutely. All right. So we have a question. Talk to me. What do we have?
Yes, it's Bardon. And he says, I assume the captive is in the pool. If my client files a claim, do others in the pool get affected by my client's claim?
Yeah. So the question is, if I have a claim, do other people in the risk distribution pool, are they adversely affected because of my claim? There's a lot of people in the risk distribution pool. And we're going to talk about that a little bit later, how that works. But by law, you're required to distribute your risk. The way you do that is participating in a risk distribution pool. There's a lot of people in there. So when somebody files a claim, everybody gets a tiny piece of that claim. So yes, you'll have some impact on there. That is normal. And oddly enough, I know this sounds weird. This is good. Because do you know any insurance companies that never have claims? I don't. A normal insurance company is going to have claims. So yes, you're going to have some claims in there, and everybody will take a little piece of that. It's not a tremendous amount, but it is some. So that's a good question. Thank you for asking that. And we'll hit on that a little bit more, and maybe you'll have a follow-up question as we go through it there. The third thing is you're going to be creating a new asset or corporation that's creditor proof. Can people sue your business? Yes. Can people sue you personally? Yes. And they can get money in your business, money from you personally. But if you have a captive, they can't touch the captive. All the money that's in there is creditor proof. No one has standing. And the big thing is it's a licensed insurance company. And the law states you cannot force the liquidation of a licensed insurance company. Why? Because it's there to pay claims to the business it is insuring. We've had this happen before. It works out really, really well for the business owner. You want to put money where it is protected, and a captive, all the money that's in there, that insurance company is protected. So it's a huge benefit. You could do a captive just for that reason, right? There's a lot of reasons to do a captive. One of the biggest reasons that people love is because it decreases taxes. Being a CPA, this was the first thing that caught my attention on the captives. Again, I want to emphasize that a captive is there for insurance purposes. It is there to insure a business. It just happens to come with a great tax strategy. CPAs, business owners love the way the taxes work. And here's why the way it works. The premiums are deductible from the business. So for every, let's say they have an S Corp or LLC, pass-through entity. For every 100,000 that they take as a business expense from their business into their captive, they're saving $40,000 in taxes if they're in the 40% tax bracket. So for every 100,000, right? So if I put in $500,000, I save 200,000. If I put in $1 million, I just saved 400,000 because the premiums are a tax deductible for the business. They're an insurance expense. Now, when the money goes over to the captive, is it premium income? Yes. But this is where there's a special exemption for small insurance companies that says you can exempt up to $2.3 million per year and not pay any tax on it. So I saved 400,000. Let's say I put in $1 million, right? So, or over here, the million goes over here. I still have my $1 million because I don't, yes, it's income, but I get to exempt that income from taxes. People love that aspect about it. Now, you do eventually pay tax on what is pulled out of the captive, but it's at capital gains rates, 15–20%. So, right, you're saving 40 to 50%. If you live in California or New York, it's 50%, right? So you're saving a tremendous amount on the front end. You're deferring that tax and keeping all that money and having it grow. And then when you pull money out, you're only paying capital gains rates, which are much lower at 15 to 20%. Quick example, just a really simple example. If you have net income of 500,000, you start a captive, you put that you have captive premiums of 500,000, it goes into your captive, it's premium income, but you get that exemption up to 2.3. So you're not paying any tax on that. So your taxable income for your captive is zero. Your taxable income for your business is zero. Your client just saved $200,000. It makes them pretty happy. It makes them pretty happy. Give you an example of this. There's somebody had a business where they built facilities on the border, and they had a good year. They made $1.5 million, and the owner is happy. We're all in the meeting. The attorney was in there, the CPA, financial advisors there, the financial advisor was in there, and the business owner gave him, $1 million to invest because he's like, hey, get my money growing. And, I just made the comment of, hey, you need to hold some of that back because you're going to be paying about $400,000 in taxes. What? No clue, right? Or you could create a captive insurance company, put the $1 million in the captive insurance company, and then you get to save $400,000. And that business owner looked at the financial advisor and said, give me back my money, right? I'm going to put the money into the captive, and then you can invest it because I'm going to get a 40% return on my money, just like that. And he was right. That's exactly what he would do. So a tremendous benefit is there. It's a great way to keep your money, grow your money. Another one that's very, very popular with CPAs. We, a lot of times, hey, we're trying to reduce taxes at the end of the year. In this particular case, a CPA suggested, hey, go buy $700,000 worth of equipment. They did. They didn't really need it. They just didn't want to pay a tremendous amount of taxes. In 5 years, how much is that $700,000 worth? Probably $200,000. Right? I mean, it depreciates greatly. The value of it goes down. Or you could have a captive the next year. Another CPA suggested, put the $700,000 in a captive because you're putting it into an investment that goes up through stocks instead of goes down. The value of that in 5 years is 1.5 million. I call this the $1 million miss because the value is that big of swing. Right? It's a huge, huge swing. So that's that as far as what it does on the tax element of it. Any questions on that so far? Are we good? All right. I said it protects the business. It decreases taxes. And third, it builds wealth. How does it build wealth? The money that you put into the captive, you get to keep. You retain it. Think of it as returnable premiums, right? All the premiums are returnable. You're keeping the money inside of there, but we just don't want to keep it in there. We want to invest that money. You can invest that money into Wall Street funds, right? Stocks, ETFs, things like that. It's got to be liquid. So you can't go buy a building with the money that's in the captive, but you can invest in various different stocks. So you are retaining that money, you're investing that money, and then all the policies are reinsured. We're not going to go over this just for time purposes, but when you compare this with a qualified retirement plan, it blows it out of the water. This is what a captive does. All your other qualified plans, there's gaps in them, right? I can put a whole lot more as a business owner into a captive than I can an IRA, right? Or a SEP. So, when you do retirement plans, great, but you're not getting any business benefit out of that. Whereas if you do a captive, you're getting a business benefit out of doing that. Again, feel free to contact me regarding that if you have questions on that. The other thing that it does is we mentioned this earlier, it reduces your traditional insurance cost. How do we do that? We're going to increase the deductible on your traditional commercial insurance. If you want to, you don't have to. We'll just look to see if it makes sense, if it lowers your cost. For this particular construction company, it did. Big construction company, again, not all of our clients are this big, but all their insurance altogether, general liability, workers' comp, commercial auto, added up to $2.5 million. They started a captive. We increased the deductible. We insured the deductible on the captive side. So if we needed that money to pay for a claim on the commercial insurance traditional side, we got it. Their premiums went down by nearly $1 million. Do you think that client was happy? Absolutely. Absolutely. They have more insurance than they ever had. And now they have an extra $1 million in their pocket. It's powerful. It's a powerful strategy by incorporating a captive into your insurance strategy. This is another one. We have people that this is the only reason why they do a captive is because they want to create a warranty or an insurance program. It's a natural add-on. When you go to Best Buy and you buy a TV, what's the last thing they ask you at the cash register? Do you want the extended warranty? That's a captive, right? You go buy tires, same thing. Do you want the warranty? Sure, you never use it. All that is extreme profit, right? It creates a whole new revenue stream for the business. It creates the money that goes from the warranty goes into the captive. And remember the tax rate on the captive? It's 0. So you're creating a whole new revenue stream. No taxes on that, and you're increasing the value of the company. And another big benefit is that it's a competitive advantage, right? Your competitors may not offer that warranty. You can choose to charge for the warranty or don't charge for the warranty. I'll give you an example of that. A traditional commercial range company, you know, the ones that are in restaurants, they're expensive, right? They're about 10 grand. And so a company contacted us, said, hey, can we do a warranty? Everybody does just a 1-year warranty. Can we do a 2-year warranty? We don't even want to charge for it, but can we just do a 2-year warranty that the captive covers? Do it. Guess what happened? Sales went through the roof. Because if I'm going to throw down $10,000, I want to make sure the range works for 2 years, at least, not just 1. Do you see how that's a competitive advantage for your client? It's huge. It really is. So why choose a captive? You're getting more coverage, right? You have all these gaps, things that your client is currently self-insuring for. They're just hoping it doesn't happen. Why not get a captive to cover that? So without a captive, you're left exposed. You're paying a tremendous amount of taxes. I mean, we all hate taxes, right? 40%, you got $500,000 profit. You're going to pay $200,000 in tax. You keep $300,000. You're not covered for business interruptions or collection receivables or your deductible or loss of key. You're not covered for any of that. But if you had a captive, it's going to cover all of those things. That $500,000 of profit can go to your captive. And look how much tax you pay there. Nothing. That's a pretty good year, right? So you're keeping that $500,000. It's not dollar for dollar on the insurance. So that $500,000 may be buying, $10 to $30 million worth of insurance, right? And so you get a whole lot of insurance. You save a tremendous amount of taxes, and then it builds wealth. You keep the $500,000 and you invest it. Maybe you make $50,000 on top of that. So most of the time when you do a captive, you end up financially ahead. I have more money at the end of the day by doing a captive than by not doing a captive. And it happens to do with the tax situation. So that's, it's really, really beneficial. It's a true licensed insurance company. The purpose must be for risk management. All the policies are actuarially supported. We use a third-party actuary, not us, that will determine the policies. You got to capitalize your company every year. There's got to be risk transfer and risk distribution. We had a question on this. It's a requirement. It's not ours. Okay. It is a requirement by state law. All of ours are state licensed insurance company. I'll show you how this works briefly. Your premium, when you start a captive, half of that premium is going to go into the risk distribution fund. Okay. It's just held up there. It's not gone. It's just held up there for a year because the insurance law states you've got to, if you're just moving money from here to here, you're not distributing any risk, right? But if you use a risk distribution pool, then risk is being distributed there, right? At the end of the year, there'll be some claims in there, okay? It's averaged over the last decade around 2 to 3%. So it's really low. That's a whole, it's really, really low. And so after that money is deducted, and the rest of that money then goes down into your captive. 49% of the premium immediately goes into your captive as an investable, and it's investable. So it works great. It's a great strategy, but yeah, that is how the premium does flow. And that happens every single year for however much premium you put in. And every year you can decide how much you put into the captive. Obviously, the actuary will give you a top limit, but below that, you can go, some years you may put nothing in, right? And your expenses will be extremely low on that. We have a clean captive checklist. Very important that you do these things correctly. Being a CPA, we make sure that that is done correctly every single time. All of ours are done onshore. We don't do offshore captives. We think there's been problems with those in the past. There's a lot of case law that supports captives. It takes 30 days or less to create a captive insurance company. The first thing is a feasibility. We do this complimentary. We want to see, does this make sense for your client? All right. And, any type of business, do they do at least around $1 million in gross revenue? Then this is something they should look at. What we'll provide is an analysis. We'll give them an idea of what kind of policies they could get. What are the costs? What's the cost benefit here? We don't want the cost to be more than the benefit, right? And then what's the tax analysis? What's it going to do from a tax perspective? And just go over the overall structure. We don't charge for that. It's a simple 1-page form that's filled out that takes less than 2 minutes to complete. And so it gives you a really good idea of what a captive would look like for your client. If they like that and they want to move forward, the next stage is the underwriting. That is where we hire an independent actuary that will value the company's risk and then come up with different policies that they can get that's applicable to them. Then we form the corporation. We handle all that part. All the captives are C Corps and then we obtain an insurance license on top of that. We handle all the tax ID number, everything associated with that. And then we manage the insurance company. There's different things you have to do, reporting you have to do to the insurance department. So it's required by law that you have a insurance manager. And that's what we do, right? We don't own the captive, but we do everything associated with the captive. So the business owner, it's kind of a hands-off deal. They just get all the benefits without having to do any of the work. It's a turnkey process. So that's captive insurance, everybody. It protects your business, decreases your taxes, builds wealth. So if you have a client in mind, feel free, let's talk about it and see if it's a good option for them. We have a question. So what is the question, Miss Denise?
All right, it is from Miss Jackie, and she would like to at some point to talk about why the IRS looks at captives and why they were thought of as being abusive tax shelters.
Yep, absolutely. So with anything, the IRS is not happy with any abuse of any thing, right? Whether it's any kind of deduction whatsoever. So the IRS is they don't want abusive captives out there. We don't either. Right? We've never had any issues with any of our captives. Remember, I said we form them onshore, not offshore. The majority of the problems that have occurred are done offshore, and they're termed abusive. What do I mean by that? Remember, I showed you risk distribution. Abusive captives don't do risk distribution. They just move money from here to here. You can't do that. You're not operating it correctly. That's abusive. They don't want that. Secondly, there's no claims. Nobody ever files a claim. Well, you're going to have different losses, right? From time to time. So you got to have that. Another one is like another abusive one that they caught was that the person put a bunch of money in a captive and then went and bought a piece of property in Arizona. You can't do that. What if you have a claim? How are you going to pay that claim if all your money's tied up in land? Well, I mean, come on, that doesn't make any sense. So you have to run these as a true licensed insurance company. That's what we make sure we do. A CPA is the last thing I'm going to do is jeopardize my license for anybody. So there are abusive ones out there. We don't have any. So you just want to make sure that you do them correctly. If you do, again, we've never had any trouble with anything. We have another question. What's our question, Denise?
From Jasnick, and he's got 2 quick questions. Firstly, your experience with shared series. He's currently working on a deal that will need that as part of the solution. And then do you have experience with legal cannabis companies and getting the captive premiums deducted tied to costs? Yeah,
so the first question is on shared services. Captives come in all kind of flavors, right? There's what's called risk retention groups that we can form for that purposes. There's also called, you may be referring to sell companies. That's where if a company doesn't have enough revenue, it's not large enough to justify a standalone captive. You enter into a cell structure. All the cells are separate C corps. This is this way a lot of captives are formed. So we have a lot of experience in that, or you could do a standalone captive. So yeah, we'll definitely get together offline and kind of talk a little bit about that. But that's why, a lot of times, I think this is what you're getting to. A lot of people may have issues. Like we have an issue with farmers, pig farmers, actually in the north. They're smaller, but there's a bunch of them. So we're looking at setting a captive up to cover all of them to help lower their expense costs and cover unique things. So that's a good question on that. The cannabis industry, that has taken off, right? I mean, good night. If you go out in the state of Texas, there's cannabis left and right, right? Yes, cannabis companies can form captive insurance companies. However, the main sticking point to that is that they have to have a bank. They have to be banking with somebody. And that's where you're going to run into trouble. With the captive, yeah, you got it. Yeah, go ahead.
I unmuted, I figured. So this is so I've got 26 cannabis guys. Average business revenue 10 to 40 million. Guys are grossing 2 to 8 million in profit. They are bankable. There are some cannabis friendly banks in my area. The issue is that I've had or bumped into, which has kind of put me on this quest for a new captive provider, is that I can't get a legal opinion saying that this expense is deductible, right? So again, I'm not a CPA, but my understanding is that they're not able to take deductions on anything that isn't directly tied to COGS. And so we've struggled with these clients to move or to get an opinion where I can get the captive insurance premium tied into COGS. Yeah. And then therefore making it deductible.
Right. Yeah. So we have an attorney firm that does exactly that. So they give you a legal opinion on that, and then we can set them up as a captive. So if you've got the banking relationship, that is the most important part of this. For those on the call not familiar with it, there's certain federal rules that prohibit most banks from touching the cannabis industry, even though it may be legal in a state. Federal guidelines, banking rules prohibit a lot of that. So there are some banks trying to get into it because they realize, like you already know, there's a tremendous amount of companies out there. So yes, you can form a captive with a cannabis company. But again, you just want to make sure you dot the I's, cross the T's, and that's what we make sure that we do. So if you have situations like that, we can definitely help you out in that regard. Great question. And we can get off, or we can talk offline on the details of that and move forward on some of those. Any other questions? All right. Hey, this has been great. If you got clients that you like, I wonder if this would work for them. The question is, do they do around $1 million in gross revenue? I don't mean net income after you deduct all the expenses. I mean total sales. Is it 800,000, $1 million, 5 million, 10, 20, 50 million? You want to look at a captive, and we'll show you if it makes financial sense for them or not. It protects the business, decreases taxes, and builds wealth. Feel free to give me a call, or if you have a client in mind, we'll run a feasibility study and see if it makes sense for them. Give me a call anytime, or ken@captivenation.com, or 888-944-5588. I appreciate it. Give me a call anytime. Thanks. We'll see y'all next time.